Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Risk and return in stock market investing. Investing in the stock market isn't just about picking the right stocks, it's about understanding the balance between risk and return. Every investor faces the challenge of managing this balance. Getting it right means more than just potential profits. It means safeguarding your financial future. Understanding risk and return is crucial for making informed decisions. Risk is the chance that your investments will lose value, while return is the gain you expect to make. Higher returns often come with higher risks. This video will dive into why this relationship matters and how you can manage it to maximize your investments. Whether you're a seasoned trader or a beginner, you'll learn valuable strategies to balance risk and reward effectively. Understanding risk in stock market investing. Investing in the stock market can be a thrilling yet daunting experience. Knowing the types of risks, how to measure them, and understanding past events can help you make informed decisions. Let's break it down. Measuring risk. Understanding how to measure risk is just as important. There are a few key tools to help you gauge the risk of your investments. 1. Standard deviation. This measures the amount of variation or dispersion of a set of values. 1. In simple terms, it shows how much the returns of a stock can deviate from its average return. 1. Higher standard deviation means higher risk. 2. Beta. Beta measures a stock's volatility compared to the market. 2. A beta greater than 1 means the stock is more volatile than the market, while a beta less than 1 means it's less volatile. 3. Value at risk, VAR. VAR estimates the potential loss in value of an investment portfolio over a set period for a given confidence interval. 3. It helps investors understand the possible maximum loss. Understanding return in stock market investing. Investing in the stock market can be an exciting journey, but it's important to understand the returns you might expect. In this section, we'll break down the different types of returns, how they're measured, and how the stock market has performed historically. Types of return. 1. Capital gains. Capital gains are the profits you make when you sell a stock for more than you paid for it. 1. For example, if you bought a stock at $50 and later sold it for $70, your capital gain is $20. 1. Capital gains can be short-term or long-term, depending on how long you held the stock before selling. 2. Dividends. Dividends are payments made by a company to its shareholders, usually from profits. 2. Companies might pay dividends quarterly, annually, or at different intervals. 2. These payments can be a steady source of income. 2. Even if the stock price doesn't rise, dividends can boost your overall return. 3. Total return. Total return includes both capital gains and dividends. 3. It's a comprehensive measure of what you earn from your investment. 3. For instance, if you own a stock that appreciates by 5% and pays a 2% dividend, your total return is 7%. Measuring returns. 1. Return on investment, ROI. ROI measures the gain or loss generated relative to the amount invested. 1. It's calculated by dividing the net profit by the initial investment cost. 1. If you invested $1,000 and made $1,200, your ROI is 20%. 2. Compound annual growth rate, CAGR. CAGR shows the mean annual growth rate of an investment over a specified period of time longer than 1 year. 2. It's the rate at which your investment grows if it increases in value at the same rate every year. 2. For example, a $1,000 investment growing to $2,000 over 5 years has a CAGR of about 14.87%. 3. Annualized returns. Annualized return is the geometric average amount of money made or lost by an investment each year over a given period. 3. It helps to compare returns across different time frames. 3. For instance, an investment that grows from $1,000 to $2,000 in 4 years has an annualized return of about 18.92%. Historical performance of stock markets. Looking at historical performance can give you an idea of what to expect. While past performance doesn't predict future results, it can be informative. 1. U.S. stock market. Historically, the S&P 500 has returned about 10% annually over the long term. 2. Global markets. Different markets have different returns. 2. For instance, the MSCI World Index, which measures global stocks, has had an average annual return of about 7–8%. 3. Emerging markets. These often show higher returns but come with higher risk. 3. The MSCI Emerging Markets Index has seen annual returns in the range of 10–12% over the past decades. By understanding these types of returns and how to measure them, you can make more informed decisions about your investments. Historical data gives context, helping you gauge what might be a reasonable return expectation based on past trends. The risk-return trade-off. Investing in the stock market involves a balancing act between risk and return. Simply put, the more risk you take, the higher your potential return. Let's break down this idea by looking at two important concepts. Correlation between risk and return. When you invest in stocks, there's a direct relationship between risk and potential return. If you choose high-risk investments, you might see big gains or big losses. For example, investing in tech startups can offer huge returns if the companies succeed. But, if they fail, you could lose your investment. On the other hand, lower-risk investments usually offer more stable but smaller returns. Think about big, established companies like Coca-Cola. Investing in such companies is generally safer, but the growth of your money will likely be slower. Here's a quick comparison. 1. High-risk investments, tech startups, cryptocurrency. 2. Low-risk investments, established companies, government bonds. Risk and return are like two sides of the same coin. The higher the risk, the higher the potential return. But remember, higher potential return means you're also more likely to experience bigger losses. Modern portfolio theory. Harry Markowitz introduced the modern portfolio theory, MPT, to help investors understand how to balance risk and return. His theory is all about diversification. But what does that mean? Diversification is like not putting all your eggs in one basket. Instead of investing all your money in one type of stock or one company, you spread it out across different investments. By doing so, you reduce the risk of losing all your money if one investment goes bad. Here's how MPT helps you. 1. Reduce risk. By holding a mix of different types of investments, the risk of any one investment hurting your portfolio is lowered. 2. Optimize returns. The theory suggests that with the right mix, you can get the best possible return for a given level of risk. 3. Adjust for comfort. You can adjust your portfolio to match your risk tolerance. 3. If you want to be safer, you invest more in stable assets. 3. If you're okay with more risk, you can invest more in higher risk assets. Modern portfolio theory is like creating a balanced diet for your investments. You wouldn't eat only fast food or only vegetables. A mix keeps you healthy. In the same way, a mix of investments keeps your portfolio healthy and more stable. Understanding the risk-return trade-off can help you make smarter investment choices. This balance is crucial, whether you are just starting to invest or have been doing it for years. Strategies for managing risk and maximizing return. When it comes to stock market investing, balancing risk and reward is key. The right strategies can help you protect your investments while still aiming for those high returns everyone dreams of. Let's dive into 3 essential tactics: diversification, asset allocation, and regular monitoring and rebalancing. Diversification. Diversification is like not putting all your eggs in one basket. By spreading your investments across different types of assets, sectors, and even geographic regions, you can reduce the impact of a poor-performing investment on your overall portfolio. This approach can smooth out those unpredictable market ups and downs. 1. Variety of stocks. Invest in different industries like tech, healthcare, and finance. 2. Types of investments. Mix stocks, bonds, and real estate. 3. Geographical diversification. Don't limit yourself to U.S. stocks. 3. Look at global markets. By diversifying, you don't rely on the success of a single investment. This way, even if one investment struggles, others may perform well, balancing your portfolio. Asset allocation. Asset allocation refers to how you distribute your investments among different asset classes, such as stocks, bonds, and cash. The goal is to find a balance that matches your risk tolerance and investment goals. 1. Risk tolerance. Are you okay with high risk, high reward investments, or do you prefer a safer approach? 2. Investment goals. Are you saving for retirement, a home, or your kids' college fund? 2. Your age can also play a role. Think of asset allocation like a pie chart, where you decide how big or small each slice should be based on your comfort level. Regular monitoring and rebalancing. Investments are not a set it and forget it deal. Regularly checking your portfolio and making adjustments ensures you stay on track with your risk and return goals. 1. Why monitor? 1. Market conditions change, and so do the values of your investments. 1. By keeping an eye on your portfolio, you can spot when something isn't working as planned. 2. Why rebalance? 2. Rebalancing is like tuning up your car. 2. If you start with 60% in stocks and 40% in bonds, but stocks grow faster, you might end up with 70% in stocks. 2. This shifts your risk. 2. Rebalancing brings your portfolio back to its original setup. 3. Frequency. Check your portfolio at least once a year. 4. Thresholds. Set limits for when you'll rebalance. 4. For example, if any asset class shifts by more than 5%. By monitoring and rebalancing, you ensure that your investments align with your changing life and market conditions. These strategies, diversification, asset allocation, and regular monitoring and rebalancing, are essential tools in managing risk and aiming for higher returns. By adopting these practices, you can build a robust, resilient investment portfolio. Psychological aspects of risk and return. When it comes to the stock market, numbers and charts are just the surface. Dig a bit deeper, and you'll find that psychology plays a massive role. Understanding these psychological aspects can help you make smarter investments. Behavioral finance. Behavioral finance looks at how our emotions and biases affect our investment decisions. Unlike traditional finance, which assumes people are always rational, behavioral finance recognizes that we're often not. 1. Overconfidence. Many investors overestimate their knowledge and ability to predict the market. 1. This leads to taking unnecessary risks. 2. Loss aversion. People generally hate losing more than they love winning. 2. This can make them hold on to losing stocks for too long, hoping they'll rebound. 3. Herd behavior. Ever buy a stock because everyone else is doing it? 3. That's herd behavior. 3. It can lead to bubbles and crashes. These psychological tendencies affect how we perceive risk and return. For example, the pain of a small loss might outweigh the joy of a significant gain, making some investors overly cautious. Risk tolerance. Risk tolerance is your ability to endure market fluctuations without panicking. It varies widely from person to person and is often based on age, financial situation, and even personality. 1. Age. Younger investors typically have a higher risk tolerance because they have more time to recover from losses. 2. Financial situation. If you have a stable job and an emergency fund, you might be more comfortable taking risks. 3. Personality. Some people are just naturally more risk-averse. 3. They prefer the safety of bonds over the volatility of stocks. Understanding your risk tolerance is crucial. If you're too risk-averse, you might miss out on high returns. On the other hand, if you're too aggressive, you could face significant losses. The key is to find a balance that suits your comfort level and long-term goals. Understanding the risk-return relationship is crucial for success in stock market investing. Higher potential returns often come with increased risks. Assessing your risk tolerance helps you make smarter choices. Use diversification to manage risk and improve potential returns. Staying informed and adaptable in your strategies can lead to better financial outcomes. Balance risk and return to achieve your investment goals. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.